For going on 20 years now, I've helped hundreds, if not thousands of people plan and transition successfully into retirement. And in this video, I'm going to share with you 4 things that often surprise people the most when they are in retirement. Now, before we do that, for those that are new to the channel, I'm Jonathan Rankin. I'm the founder of Theorem Wealth. We're a retirement-focused wealth management firm, and I've been helping people plan and execute their retirement goals for going on 20 years now. So welcome to the channel, and if you've been here before, welcome back. Make sure you hit that subscribe button so you don't miss any of our retirement planning videos. Now, the first thing that surprises many people has to do with Social Security. More specifically, taxes on their Social Security. You see, many retirees discover that their taxes generally go down once they retire, but there's one area that still manages to catch them off guard, and that is how Social Security benefits are taxed. Well, it's common knowledge that the government's going to tax other retirement income sources like pensions and money that comes from tax-deferred savings accounts like 401ks. The rules around Social Security can be a little bit of a shock if you're not prepared for it. And this is because it's not always obvious who needs to pay tax on their Social Security or how much they are expected to pay. In many states, Social Security benefits aren't even taxed. But the Social Security Administration says that about 40% of people who receive benefits end up paying federal income taxes on those benefits. And here's how that works. If you're filing taxes on your own and your total income, including what you're getting from Social Security, falls between $25,000 and $34,000, you might need to pay taxes on up to half of those benefits. And if your total income is more than $34,000, then as much as 85% of your benefits could be taxed. Now, those that are married filing jointly with a spouse, if your combined income is between $32,000 and $44,000, you could be taxed on up to 50% of your benefits. And if your combined income is over that $44,000, then you could be taxed on up to 85% of your benefits. Now, with the recent cost of living adjustments being higher than what we've seen over the past few years due to inflation, the increases could impact your overall income and create an unplanned tax issue. One thing to remember while planning for your taxes is the income that you receive from your savings and investment accounts, especially if you've transitioned some cash into things like money markets or CDs, because we've seen money market and CD rates a lot higher than where they've been since 2008, and that can create an increase in your taxable income as well that will impact your Social Security taxation. Real quick, sorry to interrupt. I have a crazy stat for you. Do you know that 96.5% of you that are watching this channel frequently have yet to hit the subscribe button? So if you like this video and you like what we do here, can you please do me a favor and hit that subscribe button? And in return, I promise you that I will do everything I can to make this channel more informative, more entertaining, and overall just better. So thank you. And now we can go back to what we were talking about. The next surprise that I've seen happen quite a bit has been in the planning stage of retirement. You know, the 2 to 5 years before you actually retire. And we take a very active role in planning for retirement. And to really do it right, we believe that it has to be very comprehensive. And what we found is that many people change jobs over the years and end up forgetting about retirement accounts that they might have set up years ago. Now, it's not hard to see how people could forget about an old 401k. In fact, the Bureau of Labor Statistics found that people born between 1957 and 1964, for instance, had on average about 12.4 jobs by the time they were 54. Now, with every new job potentially is adding another retirement account into the mix, and it becomes increasingly difficult to keep an eye on every single one. Now, this might explain why there are about 24 million neglected 401k accounts out there with more than $1.3 trillion sitting in them. Now, if these accounts get in order for too long, they might be cashed out and handed over to the state as unclaimed property, missing out on the chance to grow over time. Right now, if you leave a job with up to $7,000 in your retirement account, your employer might move that money from the 401k into what's called a safe harbor IRA for you, assuming that their policy allows for that to happen. The Department of Labor is proposing a regulation that says it would reduce the number of lost retirement accounts as well as cash outs when workers change jobs. So there's a new rule that's being suggested, and it comes from the Secure 2.0 Act, which we've covered quite a bit on this channel, which would let companies charge fees to move your safe harbor IRA directly into your new job's retirement plan without you having to do anything. The system would let certain providers look up your old and new retirement plans to link them up. Then they could automatically transfer your IRA savings into your new employer's retirement plan for you without you having to do anything. Now you might be thinking, Jonathan, I get happy when I find a $5 bill in an old pair of pants, let alone thousands of dollars that might be forgotten about in an old retirement account. That's a great thing. And it is a good thing. However, depending on the amount that's in that forgotten retirement account, that could have been the reason why you might have delayed retirement. And that's where I've seen this become an issue. Imagine if you were planning on retiring at 65, but you could have retired at 62 just by locating all of your accounts. That's 3 years that you spent working when you could have spent enjoying your retirement years. Now, the next surprise often happens years after retiring. You see, even as I mentioned earlier, many retirees see their taxes go down, and that's what they expect for their retirement. But for some, that reduction in taxes is often short-lived, because one of the biggest surprises I've seen people experience is how high their income can get when required minimum distributions kick in. Because if you've been contributing your entire career to a tax-deferred account like a 401k, then when you're retired and you begin to take withdrawals from that account, it will count as ordinary income. Now, as the saying goes, the only thing certain in life are death and taxes. And for decades, Uncle Sam hasn't taxed any of that savings. So when you're in your 70s and you're forced to take money out of that account, it's going to be taxed. And depending on the value of your account, your RMDs could push you into the highest tax bracket possible, much higher than when you were even working. Now, to avoid this problem, it's important to plan early and identify whether or not this is going to be an issue when you are retired and you're forced to take required minimum distributions. You may want to consider whether or not Roth conversions could help solve this issue. And depending on your age and balance, you could even consider whether or not investing in a Roth 401k versus a traditional makes sense. I've seen this be the case when someone works for a company and invested all of their money in that company's stock. Not something that we recommend, but in this case it happened and that stock took off, and now they are younger, but they have an extremely large 401k. It's important to start planning for taxes and RMDs in retirement as early as possible. Now, the last surprise shouldn't be a surprise to people if they've been watching this channel for a long time, because we've talked about this topic quite a bit. And that is how many people are surprised to find themselves bored, lonely, and even missing work after they retire. See, retiring marks the end of your career, but it's the beginning of this new phase of life that has an unlimited amount of free time. And the question always becomes, how are you going to fill that free time? What are you going to do? Who are you going to spend time with? The options for your retirement days are endless, and some people, they find it easy to be able to jump into new hobbies or social groups, yet for many people, navigating that transition can be extremely challenging, sometimes leading to the feelings of loneliness and isolation. And studies have actually found that the lack of social connection can heighten health risks as much as smoking 15 cigarettes a day. That's why it's important to not only focus on the financial aspects of retirement and plan for those things, but also the social. What we like to tell clients is, let us figure out the numbers for you, show you what life can look like, but it's also important to have a conversation about what are you going to be doing? What does that look like for you? And that's why, in fact, in our video last week, how we discussed that more and more people are opting for a gradual retirement so they can test the waters and get used to their new lifestyle. Retirement should be the best time of your life. It's what you worked so hard your entire career for. That's why it's important to plan as much as possible before you retire. And the last thing that people want in retirement are surprises, and the best way to avoid those is to plan. If you're wondering what retirement looks like, or if you're on track to your retirement to make sure that you avoid any surprises in your upcoming retirement, then make sure you use that link in the description below and schedule some time with a member of our team. We would be more than happy to help you see if you're on track and what retirement looks like for you. Thank you so much for watching. And once again, if you only hit the subscribe button one time today, we'd love for it to be on this channel. Thanks again. I'll see you next time.